Warren Buffett once said, "Be fearful when others are greedy and greedy when others are fearful." But the question is, how do we accurately judge market greed and fear? Today I'll share a strategy that uses technical indicators to find a quantitative answer to this famous quote. Welcome to the Inventor Strategy Selection channel. Many traders have experienced this painful situation when the market is optimistic and everyone is talking about getting rich quick. You can't resist jumping in, only to become the last buyer, or when the market falls into despair with everyone exiting at a loss. You are too scared to buy the dip, watching the rebound pass you by. This human weakness of chasing highs during collective euphoria and fearing lows during collective despair is almost every trader's destiny. Today we'll explore a strategy framework designed to enhance technical analysis decision-making. Unlike relying on single or few indicators, it builds a consensus evaluation system covering multiple classic indicators across different dimensions: trend, momentum, oscillation. When this group of indicators sends highly consistent signals, it may reveal extreme market sentiment, which is exactly when rational investors should be cautious and potentially take contrary action. Understanding how it converts multiple signals into a quantified assessment of market consensus for contrarian trading is key to mastering this strategy. This strategy's core lies in its contrarian thinking and quantification of group consensus. It systematically integrates multiple categories of classic technical indicators, including EMA10-200 across different periods, RSI, Stochastic CCI, momentum, and MACT histogram, creating a comprehensive market observation network. The key innovation is that it doesn't simply follow traditional buy-sell signals from these indicators, like overbought or oversold conditions. Instead, it treats each indicator as an independent observer and tallies their individual judgments about market direction, bullish or bearish, at the current moment. The essence of this strategy is its contrarian application of extreme consensus. When the indicator group shows overwhelming agreement toward bullishness or bearishness, this often signals that market sentiment may have reached extremes and a turning point could be near. At this point, the strategy takes contrary positions, seeking long opportunities during extreme bearish consensus and short opportunities during extreme bullish consensus. The core value of this approach is that it tries to capture moments when market participants, especially emotionally driven crowds, may have collectively fallen into irrational states, and this extreme consensus itself can become a catalyst for price reversal, offering potential opportunities for rational investors with contrarian mindsets. The strategy uses 4 parameters to control trading timing. Entry long is set to 12, meaning when signal count exceeds 12, it opens a long position. Short entry uses a mirror design with entry short set to -12. The closing parameters, close long and close short, are set to -9 and 9 respectively, slightly more relaxed than the entry thresholds. This design reflects the idea that we want stronger certainty when opening positions, but can be more flexible when closing them, both capturing profits and not being too greedy to miss profit-taking opportunities. This asymmetric entry-exit strategy effectively reduces trading risk. Entry requires extreme signals to ensure high win rates, while exit is relatively loose to secure timely profit-taking. This parameter design differs from traditional fixed value judgments, as it's based on the relative distribution state of the indicator group, giving the strategy strong environmental adaptability. The parameters are neither too sensitive, causing frequent trading, nor too sluggish, missing important turning points, finding a delicate balance in changing market environments. The strategy builds a comprehensive technical indicator matrix, like creating an army with multiple types of troops working together. It includes the following technical indicator combinations: the moving average family, with both EMA and SMA across 6 different periods from short to long term, and 5 oscillators and momentum indicators, RSI, Stochastic K-line, CCI, momentum, and MACT histogram. This indicator combination not only covers both trend and oscillation schools of technical analysis, but also integrates market information from different timeframes, forming a 3-dimensional market scanning network. The innovation of this multi-dimensional indicator integration is that it avoids the limitations and biases of single indicators, providing a more comprehensive and balanced market perspective. All these use mature functions in Pine language, and you can modify specific parameters based on your market experience. Here is the core calculation part of the strategy, using 2 counters, above count and below count, to tally bullish and bearish indicators. For moving averages, the rule is simple: if the average is above price, it counts as a bearish vote; if below, a bullish vote. This logic is straightforward. Price above a moving average typically indicates an uptrend, while below may signal a downtrend. Other indicators have their own judgment criteria. RSI above 50 counts as bullish, Stochastic K-line above 80 represents strengthening bullish momentum, CCI above 100 counts as strong, bullish. Momentum indicator and MACT simply look at positive or negative values to determine direction. Many experienced traders might question this approach, using common moving averages and MACT for trend-following trades, while using RSI, Stochastic K and CCI to go long in overbought areas and short in oversold areas. Isn't this asking to be caught in a trap? Don't worry. The brilliant reversal part is coming up next. The signal generation mechanism shows advanced market psychology application. The core calculation is below count minus above count, which directly reflects the extremity of market sentiment. When this difference exceeds 12, bearish indicators have overwhelming dominance, the market is deeply pessimistic, and the strategy goes long to capture oversold rebounds. When the difference falls below negative 12, bullish indicators dominate, market sentiment is overly optimistic, and the strategy boldly shorts, waiting for the bubble to burst. The psychological foundation for this contrarian approach lies in the irrational features of group behavior. When everyone is bullish, it's often the top. When everyone is bearish, it's often the bottom. The exit mechanism is more sensitive, considering exiting when market sentiment weakens from extremes, with differences reaching positive or negative 9, reflecting the trading philosophy of cut losses and let profits run. The brilliance of this strategy is quantifying complex market emotions into simple numerical comparisons, capturing human weaknesses through statistical methods, being fearful when others are greedy and greedy when others are fearful. The strategy execution embodies disciplined trading, completely eliminating subjective judgment, and letting data and logic drive every trading decision. The system automatically handles position switching according to preset rules, avoiding human weakness interference. When entry conditions are met, the strategy ignores current market panic or euphoria, resolutely executing contrary operations. This mechanical execution maintains calmness at critical moments, not letting short-term fluctuations affect long-term judgment. The exit mechanism executes strictly too, immediately starting profit-taking procedures once market sentiment begins to turn, ensuring profits are secured before trend reversal. The strategy visualization is simple and practical, showing an orange line that displays the result of below count minus above count. This line intuitively reflects the comparison of bullish and bearish indicators. When the line moves up, bullish indicators are increasing. When it moves down, bearish pressure is strengthening. T here is also a red zero line for reference, with the difference line showing market optimism above the zero line and pessimism below it. The benefit of this design is that you don't need to look at 17 different indicator windows simultaneously. Just observe this single line's changes to understand the overall situation. The line's movement itself contains information. Rapid rises usually indicate strong momentum, while slow oscillation might suggest unclear direction. While the code doesn't set up automatic alerts, you can set alerts based on this line breaking through key levels, like each thresholds. This contrarian strategy shows unique adaptability and profit potential in different market environments. At key transition points between bull and bear markets, the strategy performs best, as these moments often accompany extreme market sentiment and technical indicator consistency. When markets transition from panic to recovery, the strategy can build positions at bottom areas, capturing subsequent major uptrends. Conversely, when markets shift from euphoria to adjustment, the strategy's high position shorting often yields rich returns. In oscillating markets, the strategy's conservative nature becomes an advantage, with strict entry conditions filtering out noise trades, acting only when truly extreme sentiment appears, maintaining a high win rate. For highly volatile crypto markets, this multi-indicator collective decision mechanism is especially important, providing relatively stable judgment benchmarks in complex changing environments. The strategy particularly suits medium to long-term investors, as contrarian trading needs sufficient time for market sentiment repair and price return to reasonable ranges. When applying it, note that success largely depends on market efficiency and participants' rational return, potentially failing in long-term one-way markets or policy-dominated markets. Additionally, the strategy requires high psychological endurance, as entry timing often occurs when market sentiment is most extreme and external environment looks worst. From a strategy design perspective, this reversal system shows profound market insight and innovative thinking, integrating 17 technical indicators into a voting mechanism, and using contrarian logic for trading represents a pioneering approach in technical analysis, earning a completeness score of 4.7. For risk management, while lacking traditional stop-loss mechanisms, it builds a probability-based dynamic risk control system through multi-indicator collective decision-making and asymmetric entry exit strategies. This method, relying on statistical advantages rather than point-based stops, shows unique risk-reward characteristics in long-term operation, scoring 3.8. The strategy's market adaptability is excellent. Its reversal logic demonstrates powerful profitability in high volatility markets, scoring 4.5 for understandability, while contrarian operations create high psychological pressure. The voting mechanism itself is logically clear and intuitive, allowing newcomers to grasp core concepts with proper training, scoring 4.2. For innovation, combining group psychology with technical analysis and quantifying extreme sentiment to guide contrarian trading holds important theoretical and practical value in quantitative trading, scoring 4.8. Practicality is outstanding with programmatic execution eliminating human weakness interference and clear signals facilitating operation. Though it demands high trader psychological quality, the long-term return potential is huge, scoring 4.3. Overall, this is an excellent strategy framework with solid theoretical foundation, outstanding innovative thinking, and significant practical effects. If you have any thoughts or optimization suggestions for this strategy, please share in the comments.